We're up by around 0.6%, but some breaking news already on the trade story.
Absolutely. Redheads crossing the terminal from both sides. China to lower tariffs on U.S. goods to 10% from 125, but only for 90 days. That's the line out of China. Out of the United States, they're looking to cut tariffs on Chinese goods to 30% from 145% for 90 days. We are still waiting, again, for that press conference for the full details from this, from the Intercontinental over in Geneva. That's what we're waiting for when the commentary comes out of Scott Bessent, the U.S. Treasury Secretary, as well as U.S. Trade Representative Jamieson Greer. At the same time, we're going to get the, I believe, Chinese Foreign Ministry making some comments as well. But these are some massive numbers for 90 days.
So the figure was, we were worried that it would be 80%. That's what Trump pointed us to on Friday. We are way below that number. So in some ways, Scott Bessent, you could argue, has delivered a big win for Trump. Trump wanted this he wanted a win. He needed progress. He told us to buy stocks on the back of it and told us that that was coming. So we are starting to see some of the commentary coming out. Scott Bessent, the press conference hasn't actually started yet, but just a few moments ago, officials handed out a sheet of paper which clearly had some of the details on it. Bessent says that neither the US or China want to decouple, which is quite significant. So that is a fairly positive story coming out of this. But the details appear to be that we are going to see a substantial reduction in the tariff level that we are seeing both out of China and out of the United States. You're getting a market reaction to it, as you can see. It is interesting to see that the dollar is moving down against the US dollar. But in terms of what we're seeing elsewhere, S&P futures spiking sharply higher on the back of this. And in terms of the European market open, we've now got the Euro Stoxx 50 up by 2%. The FTSE is something of a laggard. The CAC 40 is up by 1.3%. The DAX is climbing, now up 1.5%. The FTSE MIB is up by 1.8%. So some big gains coming through. There is an area that we are focusing on, which is the pharma stocks. But in terms of that's not the story right now. The story right now is this big risk-on move that we are seeing as we see a substantial reduction in the tariff level for a limited period of time.
Massive across the board. Scott Bessent, according to these remarks, saying neither the U.S. nor China want to decouple. In the meantime, we're also seeing comments coming from the Chinese Foreign Ministry spokesman beginning their briefing. So we're still waiting for the U.S. In Geneva. We are getting, however, headlines coming out of China. They're releasing their white paper on national security as well, according to Xinhua. But I think that's a key point, because you mentioned the equity story, you mentioned the bond market story, you mentioned the currency story. Oil now at almost $66 a barrel for Brent crude, really highlighting the growth concerns that were coming out of this. It looks like China reiterating what Bessent has saying in terms of not wanting to decouple, saying they're committed to the stability of Sino-U.S. relations. Now, as we await that commentary, let's get a little bit more analysis, if we can, here from Elizabeth Engelson, the Assistant Professor of International History at the London School of Economics, but also an expert on those U.S.-China relations. Professor, talk to us a little bit about that immediate reaction there. These numbers for 90 days, not too shabby.
Not too shabby at all. I mean, there were real... I think a lot of people came into these negotiations with very low expectations. Trump had, over the weekend, set a set of expectations around 80%, but these are significantly lower than those expectations. So I do think that this is a really positive sign. But it's also important to keep in mind that 10%, 20% are still very high tariffs that in the rest of the world were what caused sort of the Liberation Day panic. So I think we're coming from a very low base, and that is the most significant shift, I think, that this is indicating real change in the US-China dynamic.
Is the 90 days significant? Like, should we worry about that? Is this... 90 days is a fairly decent period of time to get something, at least sort of to get progress on some key areas. Is that enough time? How should we think about those 90 days?
It's a fairly standard amount of time, actually. It's not, I don't think it's anything to be worried about, but I think what it indicates is a real willingness now to continue the negotiations, to continue to work towards a more sustainable way of trading between the United States and China. So this 90 days gives that buffer, but the fact that it's coming at the tariffs are much lower than expectations indicate real potential for progress.
Talk to us about the sustainability of those 90 days, because this 145% was supposed to be for 90 days. Now we've seen it peeled back. Is there a chance something like this ratchets back up?
There's a real chance of that. And I think this is something also to keep in mind, the fact that both the United States and China couldn't even agree to who it is that initiated the conversations or the need to meet in Geneva in the first place. There is real underlying tension between the two countries, even as we have today a real signal of a willingness to work together. And this really is a signal of that willingness.
OK, Scott Bessent is speaking. Let's take a listen to what he has to say.
Government for facilitating this trade meeting here in Geneva. We had very productive talks, and I believe that the venue here on Lake Geneva added great equanimity to what was a very positive process. We have reached an agreement on a 90-day pause and substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%. We had very robust discussions. Both sides showed great respect. It was a chance for me to meet the Chinese delegation. The Vice Premier I had previously had only a video call with. Ambassador Jamieson was familiar with two of the other leaders on the delegation from his previous time. So there was very good personal interaction. Both countries represented their national interests very well. We concluded that we have shared interest, and we both have an interest in balanced trade. The U.S. will continue moving towards that. I will let Ambassador Jamieson talk about the President's initiatives that began on a historic announcement, trade announcement on January 20th, which no other president has ever done, following to April 2nd, when we implemented the reciprocal tariffs.
Thank you, Secretary, and I will echo your thanks to the Swiss government and Swiss officials for hosting us this weekend. The atmosphere was very conducive to discussions, and thanks to them we were able to have very constructive and positive conversations with our Chinese counterparts, who clearly came to deal this week. The rapid nature that we were able to conduct and conclude these discussions is a testament to mutual understanding and mutual respect between the Chinese and U.S. sides. With respect to the U.S. Trade position, our interactions with China, and the agreement today, please keep in mind that the United States trade deficit has ballooned over the past several years, ending up at $1.2 trillion deficit in goods as of the end of last year, which was an approximately 42% increase over a few years prior, when there was an $850 billion trade deficit at the beginning of the Biden administration. So that is a rapid and expansive increase in the trade deficit. And our view is that this is driven in large part by non-reciprocal trade, among other things, and the result has been offshoring of manufacturing and other negative impacts on the U.S. economy. And so on January 20th, when the president was inaugurated, he released the America First trade policy, which was comprehensive and flagged that he, and actually directed agencies, including the U.S. Trade Representative and others, to research this issue and to provide options, which we did, and the president elected to impose reciprocal tariffs on April 2 to address this national emergency of the trade deficit. There was a global baseline tariff accompanied by higher reciprocal tariffs for each country depending on the level and intensity of their trade surplus with the United States. In all of this, China was assigned a reciprocal tariff rate of 34%. China was the only country that chose to implement retaliation against the United States for this reciprocal tariff. All other countries, withheld and decided that they wanted to negotiate with the United States or simply not retaliate. And so we've been in detailed discussions with other countries for several weeks at this point. China, as you know, retaliated not only with tariffs but with disproportionate and asymmetrical non-tariff measures in order to maintain the effectiveness of the reciprocal tariff measures. The president increased our tariff rates to offset Chinese retaliation. And as you know, this escalated to a point where both sides had added 125% tariffs, and with the Chinese side, additional non-tariff measures, amounting to an embargo in some senses on trade, an effective embargo, which of course was not a sustainable practice for either side. And so today, with this agreement, we come to agreement that that our reciprocal tariff rate will go down to 10% on the United States side, so it goes down 115%. We enter into a 90-day pause period for negotiations, which both the Chinese and the United States are very committed to. And the Chinese on their side also go down 115% to 10%, and they remove the countermeasures that they have in place. To be very clear, other measures that the United States has put in place in the past, whether it's tariff measures from 2018 or since, tariffs under other statutory authorities, tariffs related to fentanyl, those remain unchanged for now to the side. I'll just make one point, is that both the Chinese and the United States agreed to work constructively together on fentanyl, and there's a positive path forward there as well.
Okay, great. So let's start with some questions.
Well, just if I may make a few final remarks to give you framing and context. I think throughout the trade process, we have had a plan, we have a process in place, and now with the Chinese, after this weekend, we have a mechanism for continued talks. So process, plan, and mechanism. I would say one of the big takeaways from this weekend, the United States will continue a strategic rebalancing in many areas that were exposed as supply chain weaknesses during COVID, whether it's medicines, whether it's semiconductors, steel, we've identified 5 or 6 strategic industries and supply chain vulnerabilities, and we will continue moving toward U.S. independence or reliable supplies from allies on those. But the consensus from both delegations this weekend is neither side wants a decoupling. And what had occurred with these very high tariffs, as Ambassador Greer said, was the equivalent of an embargo, and neither side wants that. We do want trade. We want more balanced trade, and I think that both sides are committed to achieving that. We would like to see China open to more U.S. goods. We expect that as the negotiations proceed, that there will also be a possibility of purchase agreements to pull what is our largest bilateral trade deficit into balance that has gotten out of balance. And much of this has happened through neglect over the past 4 years, as the previous administration did not engage on this issue. That was put forward to us by the Chinese, in fact, and we can see it in what happened to the Phase 1 agreement. We are only looking forward, and we look forward to very good discussions now that we have the mechanism created in Geneva this weekend for talks.
Great. And with that, let's kick off questions. I'll start at the front row. Jenny, Leonard Bloomberg.
Thank you so much. Going into these talks, the president posted on Truth Social that he believes an 80% tariff on China seems right. It obviously went down substantially more. How did you end up going to 30%? Was that the president pushing you, or the Chinese not budging before you went down? And then secondly, you have a 90-day pause now, as you have with other countries. What specifically do you want to see in those 90 days? What kind of progress do you want to see in those 90 days and have agreed to by then to not ratchet up the tariffs? Because it is just a pause, right?
Yes, so
the tariffs then snap back, basically, if you don't have something agreed upon that is substantive.
So the Chinese April 2nd number was 34, continues to be 34%. I'll let Ambassador Greer answer the first question. And just like with all our other trading partners, as long as there is good faith effort, engagement, and constructive dialogue, then we will keep moving forward.
I would just say, Jenny, with respect to, the president's message and ultimate rates, I mean, everything is a negotiation, right? And the president, he gives the Secretary of the Treasury and I and other members of the cabinet direction and advice on how to proceed. And we ended up at a result that is very good for the United States, very good for China as well. We retain our 10% global baseline tariff, which we have on other countries. We have, in addition to that, previous measures that we've retained, which have been, frankly, effective in reducing the U.S. bilateral trade deficit with China over the past few years. So that leaves us in a very good position all in with respect to measures on Chinese imports, but more importantly, leaves us in a constructive path forward to have a positive conversation with the Chinese on how to rebalance and have more constructive trade.
Great. In the back, Associated Press.
Associated Press. Hi, I'm Jamie from Associated Press. We just heard our colleague talk about 30% tariffs. I'm just trying to understand these numbers here because they're all over the place. We were at 145 before, apparently, and 125, I believe, from the Chinese side. So can you say clearly now that, I think the question was, right now for the 90-day period, the U.S. tariffs on Chinese goods will be down to 30%? Is that correct for the 30? Could you speak?
So again, this agreement is really about the reciprocal tariff, which was imposed by the United States on April 2nd, and the escalatory steps which followed. Those on each side, the Chinese side and U.S. side, ended up at 125% on each other. The Chinese had additional non-tariff countermeasures. That has all come down by 115% to 10% each. The United States earlier this year imposed 20% related to fentanyl. That still exists. So if you're looking at Trump Term 2, tariffs on China, right now effective, it's 30%. There are prior measures which change by product, by sector, by level, et cetera. You can't really give a specific number on that right now. What matters for the agreement today is that we each agreed to come down on the reciprocal tariff and related retaliation to 10%. So a reduction of 115% down to 10%. Fentanyl is on its own track, but on a very positive track where we're having very constructive conversations with our Chinese counterparts.
And I would add a couple of things. This does not include any sector-specific tariffs that have been put across all of our trading partners. And as the ambassador said, I think he would agree with me that the upside surprise for me from this weekend was the level of Chinese engagement on the fentanyl crisis in the United States. They brought the Deputy Minister for Public Safety, who is not traditionally part of the trade team or the negotiating team, and he had a very robust and highly detailed discussion with someone from the U.S. National Security Team.
Great. Next, John Huddy with Newsnet.
Mr. Secretary, will there be any immediate impact that U.S. consumers will see from this? And what was the toughest part of the talks? The Chinese are, notorious for being very difficult negotiators. Was there any moment that you felt the talks could break down? And as far as the fentanyl, I'm sorry, I know there's 3 questions here, but what are the Chinese willing to do in terms of the fentanyl crisis? Did they make any promises or any agreements to combat fentanyl?
Okay. Well, there's a lot to unpack there. So let me recap that. So you're asking U.S. consumers, the last one was fentanyl, and what was the second question?
The toughest part of the negotiation.
Well, I'll start there first. Both sides represented their national interest well, but we also concluded that we had shared interest and that neither side was interested in a decoupling. And again, a lot of back and forth on various differences in views on fair trade. We informed them, I had a discussion that trade deficits are a result of three things. One, terms of trade. Two, currency. And then three, the United States fiscal position. We informed them that Trump administration is working very hard on containing this out-of-control fiscal deficit that we inherited from the previous administration. Two, there was no discussion on currency. And one, it was on terms of trade. And on fentanyl, again, for the first time, there was engagement between two teams with detailed knowledge. And I think for the first time, the Chinese understood the magnitude of what is happening in the U.S. In 2018 in Buenos Aires. They did a good job of banning the actual fentanyl, but what we have seen is substantial interaction between bad Chinese actors and many North American drug dealers, especially Mexican cartels. Treasury has designated several of the Mexican cartels as foreign terrorist organizations. We made that clear to the Chinese. They were very receptive. As you may or may not know, the Chinese have very draconian measures for the sale of illicit narcotics in China, and we have asked them to be equally as draconian with the people who are poisoning Americans.
And let me make a point. Your question about what was the toughest part of the negotiation, I would submit it was actually, in the lead up to the negotiation, trying to repair the channels of communication that had atrophied under the last administration, where, our office, for example, the Office of the United States Trade Representative, had almost no substantive discussions with the Chinese side on trade. And although we have significant differences with the Chinese on trade and economics, and we have major complaints, you have to discuss these complaints. You have to have a channel for discussions, and overcoming that was a substantial challenge. And a lot of work went into that over the past several weeks, so that by the time we got here, we were able to be very pragmatic with each other. And to be sure, there were tough things to deal with on the level of removal, the timing for implementation, managing each side's domestic politics, et cetera. And I won't go into too much detail. But I would say the toughest part was simply getting to a position where we could, in good faith, both sides work with each other. And once we did, we were able to do this in a couple of days. This is not the first time I've done trade negotiations with the Chinese, and sometimes it can take a very, very long time to overcome misunderstandings. We were able to do that effectively over the past few weeks, which enabled us to be very pragmatic and effective this weekend.
And I think we leave with a very good mechanism to avoid the unfortunate escalations as we saw after April 2nd from happening again. What had been very unusual about the relationship was that President Trump, Party Chairman Xi, they have a good relationship, but that the nature of what has happened since April 2nd could have been avoided if we had had this kind of mechanism in place. And I believe it is in place now. I think we leave today with a process that will move forward. And again, great mutual respect for our Chinese counterparts. I believe they showed us the same.
The impact on U.S. consumers? U.S. consumers see any resulting?
I mean, Mr. You're the Treasury Secretary, so you're better suited. But I would say on the front end, there's been a lot of talk about impact on consumers that just never really translate to the numbers. Consumption remained high, et cetera. And so I think what we're going to see is that we're going to have our economy continue taking off as we put structure around these negotiations and get global trade into a better place.
And as I reiterated last week, the Trump economic plan is 3 pieces: trade, tax, and deregulation. Trade has been implemented first, and that process is occurring. We believe that the tax portion is going very well. Speaker Johnson, Leader Thune, who I am in constant contact with, believe that midsummer that we will pass, as the president likes to call it, his one big beautiful bill, and we believe that that will provide substantial relief for American households. And then deregulation, a hidden and pernicious tax on American households, is regulation. We believe that the last administration added several $1,000s a year to American families' cost, and that we will be not only cutting those substantially, rolling that back, but cutting those substantially.
Thanks. I think we have time for about maybe 2 or 3 more questions. The most, sorry, ma'am, name and outlet, please.
Yeah, it's Imogen Folks, BBC. It's very heartening what you're telling us. I'm wondering whether you think it might have been a better idea to start at this point of negotiation rather than start with a big list of tariffs and all the global turmoil that caused, and the fear, frankly, in some countries around the world. How about, do you think with hindsight it might have been better to start, reach out and say we want to talk to you guys about this?
No, I disagree entirely. We have spent decades at the World Trade Organization in multilateral and bilateral negotiations trying to get other countries to reduce their tariffs and non-tariff barriers to be more reciprocal with the U.S. We've had one of the most open economies for decades. The promise of the WTO and the multilateral system is that everyone was going to come down. It turns out the U.S. went down significantly. There were other economies that had low tariffs as well, but retained very high non-tariff barriers. We have tried really hard to work within the system, and the net result is a $1.2 trillion deficit in goods. The net result is manufacturing went to China, East Asia, Mexico, et cetera. So we tried all of that. So the idea that we can just keep saying, well, why don't we just talk a little bit more and we'll have a different outcome, I think just is totally detached from reality.
And I would add a couple of things, that as our 18 important trading partners come to us, many with very good deals, as the UK, who skipped to the front of the line as our oldest ally, as Ambassador Greer and I look at their proposals, again, to lower tariffs, to lower the non-tariff trade barriers. Obviously, UK does not have a currency manipulation problem. And the subsidies for labor and industry, we look at these and I think, how did we get here? How did we get here? And I echo part of what President Trump said, that he doesn't blame the other economies for taking advantage of a fluid, taking advantage of the situation when they were allowed to do it. He blames previous U.S. leaders. So we are just trying to restore a healthy equilibrium. That the U.S. economy has become very unbalanced. On one side, we have a forward-leaning, the deepest and widest financial markets in the world. We have financial innovation. We have the tech sector that is the envy in the world. On the other side, we are a natural resources economy led by energy. So it is a barbell. But in between, precision manufacturing, especially precision manufacturing, has been wiped out. And it is our intent to bring that back. So we want to rebalance. And I think that there is a big opportunity. If I think about this weekend, the Chinese, they have gone the other way. They are unbalanced in terms of overproduction in the manufacturing sector. They have stated, but have not yet rebalanced toward a more consumption-oriented economy. And there is a chance, if we can open up trade to China, have more fair trade toward the U.S., that we could rebalance together. So I reject the notion that business as usual would have worked.
Great, and I think this will be our last question as we're just about out of time. Swiss outlet, Urs Geringer with Walsh.
Yes, I have a question with regard of the setting of these very successful talks as we hear. Switzerland has been in the center for international conferences for many decades. In recent times, we've been under tremendous pressure. The ambassador of Joe Biden to Switzerland called Switzerland the hole in the donut. My question is, how high does your administration value reliable Swiss neutrality for conferences or meetings as we just witnessed this weekend?
Well, I won't speak for the previous ambassador. My neighbor in Charleston, South Carolina, is the ambassador under President Trump, Ambassador Ed McMullen, who was highly respected here. He continues to engage with the Swiss American Foundation, and he has led this administration's effort to re-engage with Switzerland after the past 4 years. So we value the relationship. I believe Switzerland is now one of maybe the 6th largest investor in the U.S., which is incredible for an economy with 9 million people. We hope that Switzerland will bring some of its very robust trade training programs to the U.S. as we re-engage the manufacturing sector, because I believe the U.S. has a lot to learn from Switzerland. And again, the U.K. and Switzerland have moved to the front of the queue for the trade deals, whereas the EU has been much slower. So we value that also.
And I would say, with respect to the negotiating dynamics, and this may not seem important to those not involved in this, but the atmospherics provided by the Swiss government were incredibly conducive to the conclusions we had this weekend. They allowed us to use the grounds of the residence of the Swiss ambassador to the United Nations, which had a very intimate internal rooms, and importantly for us, where a lot of the key negotiations happened, were outside under a large, beautiful tree on a set of patio sofas, frankly, where we had the most important discussions on the most challenging issues. And having this setting, as opposed to, no offense to the Intercontinental, which has been great, as opposed to a sterile hotel conference situation or conference rooms, I think let us develop a personal relationship with our counterparts and lead to the successful conclusion we had.
Great. Thank you so much, everyone. I think that's it for us in time today. Thank you so much for coming out. And
Thank you.
We're concluding the press conference in Geneva at the Intercontinental Hotel in Geneva. The Treasury Secretary, Scott Bessent, the USTR, Jamieson Greer, updating reporters on the result of the talks that we saw between the US and the Chinese officials over the weekend. The market reaction has been swift. We have seen European equity markets gapping higher This news came across as we opened the market this morning here in Europe. As you can see, the stock 600 up reasonably sharply. There is a takeaway, a little kind of deduction you need to make from this, and that is what is happening in the pharmaceutical sector. We'll come back to that a little bit later. But at the moment, you have the German DAX up by 1.5%. Chinese equities also responded to this. The FTSE 100 is only up by around 0.5% at this point in time. So you're actually getting quite significant divergence here in Europe. US futures do look like this morning, as you can see, sharply to the upside. They were already up. We have added to that move this morning. This is a risk-on move that we are seeing. So while equities go up, we are seeing bond yields coming under pressure. The US 2-year is up by 8, nearly 9 basis points. The Swiss 2-year seems germane, up nearly 9 basis points. The safe haven sort of status of that market, obviously, in focus. The front end of the German market is moving quite significantly. So you're getting a big kind of risk-on move into equities, out of the bond market, Chrissy.
Absolutely. Well, the positivity continues when it comes to the FX space as well. If we were concerned about more dollar weakness, that is not the story today. Take a look at Eurodollar, for example, 111 there. We did hear Scott Bessent talking about how the EU is falling further back in the line, the UK and Switzerland moving forward. I think that's the go-to currency to look at in terms of those comments. But we have to go back to the Asian piece as well, because dollar yuan, the offshore yuan, at 720, and the Chinese yuan actually appreciating against the dollar. And I think that's crucial there. Meanwhile, you are seeing the dollar appreciate against the Japanese yen as well. So 147 on dollar yen, 720 on dollar yuan. A lot to digest there. Let's talk about the commodity picture as well, because if you're concerned about growth, the first place it's going to show up is in that oil sector. We're looking at a 65 handle on Brent crude, continuing to rise higher by about 2.8%, and a VIX that briefly, emphasis on briefly, dropped below that key 20 level for the very first time since Liberation Day. So positivity across the board. I'll even throw a little bit of gold in there. Yeah. Down about just shy of 3%. Yeah,
it was down around 2% going into this. We've seen that move continuing. Let's carry on the conversation and provide you with some analysis as to what we have just heard. Elizabeth Ingleson is assistant professor at the Department of International History at the London School of Economics, a trade expert. Benedict Lowe, equity and derivative strategist for Europe at BNP Paribas Markets 360, joining us around the table as well. Professor, let me come back to you. Just give me your takeaway. What you just heard, what does it mean? Walk us through the significance of what has just happened.
Yeah, it's been really interesting. I think what we're seeing from Scott Bessent, first and foremost, is a real attempt to take the tension, to diffuse the situation, and to start to normalise the dynamic a little more. He spoke about process, he spoke about plan, he spoke about sort of having mechanisms in place. And that's real. That tells us something about the direction that he and certain members of the Trump administration want to take things into. But it's really important to keep in mind just how volatile things still are within the Trump administration. So it's significant, for example, that it was Scott Bessent calming things and really taking things in a particular direction, and that someone like Peter Navarro, for example, another key trade advisor of Trump, wasn't involved in the talks in Switzerland and hasn't been involved in this dynamic. So we're seeing a real push on the part of Bessent to sort of diffuse tensions and normalise relations with China. But it's important to keep in mind that it's sort of papering over a much deeper, I think, set of tensions within the Trump administration that we will still see unfold in the next 90 days, if not sooner.
Well, the papering over is very much working for these markets. As Guy and I just laid out, risk sentiment is on and exacerbating what we already came into that presser with a lot of optimism built in over the weekend. Benedict, come on in here. How sustainable is this optimism that we're seeing? You just heard Elizabeth there talk about throwing a little bit of cold water on the sustainability of this deal. What about the sustainability of these gains?
Yes, I would start by saying this is, first of all, a material de-escalation. I think that was much better than what was expected by the market. And I think that it really matters from a conviction standpoint. The rally that we saw after the post-Liberation Day sell-off was a low-conviction one. And what I mean by that, it was mainly driven by systematic strategies, such as vol target or CTAs. The more discretionary part of the investment were kind of stayed on the side, especially in the US. So that will bring a bit maybe more breadth, but also just on the fact that systematic strategy has still room to re-leverage on that. So on the back of a positioning angle, there's still more to go. There is a point where too much positive news is priced into the market, and maybe there's a moment where we want to take the reversal trade, but at the moment, over the next few days, I would expect a bullish environment to be in global equity markets.
Money's coming out of the United States. Does it go back into the United States as a result of this?
Yeah, so we've seen this kind of switch from there is no alternative to there is an alternative with Europe that's benefited from that at the start of the year. We estimate that over the past 10 years, there's over $2 trillion that was invested from European investors into US equities. And we think that now there's a growth alternative in Europe. There's a German fiscal stimulus package that is there. Some of that money could be reallocated into Europe. Even if you say 10%, 20%, we're talking about 200.
Does that limit US gains, therefore, on the market?
It limits potentially US gain, but it also offers alternative opportunities for Europe that can kind of take the lead in terms of performance.
Benedict, what's the red herring there in that situation? You talked about a bullish environment over the next few days. You talk about these kind of fund flows re-entering the United States. What for you is the red flag that spooks you?
I think the red flag is too much positive news getting priced in, so kind of equity market going back to their year-to-date highs in the US, and the pocket actually where we are a bit more cautious and where we like to hedge at the moment in the US is the Russell. They have low pricing power, they're more sensitive to higher rates, so this is kind of the area where we would say if you want to hedge, go into the Russell. Maybe not the 5E, maybe not the S&P after the good earnings we had on tech sectors, but the Russell is the pocket where if too much positive news priced in, this is where we want to hedge.
Is 30% still a big number? Is 30% sounds really good right now. It's a lot better than it was before, but is it still a too high a number for small, medium-sized businesses in America? You talk about the Russell. Is that where we sort of see the pain shoving up first? I spent my weekend reading piece after piece about a small business owner here and a small business owner there that used to import a lot of stuff from China. 30% still sounds, I suspect, quite a big number, and the US consumer's already retrenching a little bit.
I think it's still a very material number, but I would say we're coming from such high numbers that were so punitive on the economy that just this has to be in the short term a relief rally. If those numbers comes in and if we stay there and there's not a re-escalation, because that's always a risk that it's a 90-day pause, we don't know what will happen. There's going to be a volatile environment, that's for sure. But if we stay there has to be risk on at the moment in equity markets.
Okay.
Benedict, we have to leave the markets conversation there. We're going to dive into the policy in just a moment. But equity and derivative strategist for Europe at BNP Paribas, Marcus 360, joining us this morning. We thank you so much for the immediate reaction on some of this optimism. Let's stick with the conversation when it comes to the policy. Elizabeth Engelson still with us from the London School of Economics. I'll put the same question I just put to Benedict to you. What is the red herring here? What spooks you?
One of the things I think that's really important is to think about the long-term structural changes happening. So yes, this is a deal that or an agreement that is coming from very, very low expectations, and that is something to really hold on to, right? This is indicating a willingness on both parts to negotiate and to try and sort of find a way forward. But I think the sort of bigger sort of concern for me is the long-term changes happening in the global economy. So in many ways, China has already, for a number of years now, been moving the structures of its economy and its trading dynamics further and further away from the United States and more as much as it can towards this policy of self-reliance. So we've seen a real decrease in China's trade with the proportion of its exports going to the United States. We're seeing even sort of in the last sort of few months with the tariff problems, China turning to its neighbours, to Vietnam and elsewhere as ways of skirting through the tariffs. So I think long term there is a structural shift happening within China to move as much as possible away from a reliance on trade with the United States. So I suppose the concern here is we hear Bessent speak of, no one wants to decouple. That is reflecting in many ways a reality that decoupling is impossible, and it has been, and these tariffs have shown that. But what China has been doing over a much longer period, and what China is continuing to do, is to shift the way that it manufactures and shift the way that it trades and produces its own energy, in fact, in ways that create a less of a reliance on the United States.
How does Bessent talks about rebalancing? He wants to rebalance. Is it possible with the numbers we've got here? What is a result out of these negotiations that leads to a rebalancing, a balancing of the US economy and the US trade deficit?
So this notion of a rebalancing and of changing the economy that way, it's really misunderstanding the way that trade operates today and the very fact of the trade deficit, right? This trade deficit has been decades in the making. It's a consequence of the way in which global manufacturing and global finance has operated really since the end of the Bretton Woods system in the 1970s. So this is the trade deficit is a product of a much longer term set of structures of the international economy that no kind of tinkering around the edges, even attempts on the part, there's less tinkering and more destructive, the Liberation Day tariffs, they're not going to be able to redress this much longer structural part of the US economy and the global economy for that matter.
I thought it was fascinating that in this press conference he talked about, or I should say that China has been increasing their partnerships with the likes of Brazil, with Mexico. He mentioned the fentanyl story, the cartels even came in. Here's what he didn't mention. He didn't mention the Treasury story. That's what the markets are freaking out about. As the U.S. Treasury Secretary, no comments on that. He did, however, kind of create a little dig there when it came to currency manipulation, which to me, those are the two red flags there, the cartels and the currency manipulation, that you could very easily pin any sort of reversal of this optimism to. Do we need to be looking at Mexico next, when it comes, or Brazil next, or some of these kind of other emerging markets in terms of the ripple effects of this?
I think I think this is really important, the cartel conversation, and part of what's important there is that is Bessent speaking to a domestic US audience as well. He's very much sort of flagging and connecting the trade talks with China to a domestic situation and the fentanyl story there. In terms of what's happening in terms of the treasuries, the other thing I'll say before I get to sort of Mexico and your question there, it's really, I think, also important this. You're absolutely spot on. The absence of talking about the treasuries is in many ways an absence of the sort of, for want of a better word, trump card that China has in wanting. It could escalate things if it had wanted to. And I think it's not in China's interest to sell off treasuries or to escalate things financially, but it's certainly a possibility. It's within China's interests narratively in terms of politics to present the United States as the one that's been creating the problems. But that is a sort of factor underlying a lot of these dynamics too.
Do you want to talk about Brazil? Should we talk about Brazil?
Yeah, talk about Brazil.
Yeah.
Because, and I say this because when we showed soybean pricing this time, I'm just kind of having deja vu from the first Trump trade war, because soy and corn are the two largest American exports. I think the number 2 is like Boeing aircrafts in terms of value. So walk me through that story in terms of China getting their soy and corn from other places.
Yeah, and this is really, really important because that is a significant sort of soft point, if you will, in sort of China's own reliance or the sort of the interdependence with the United States. And we've seen again that not just very similar in many ways to the ways that China has been shifting its manufacturing supply chain dynamics to sort of other parts of the Asia Pacific region. So too has it been shifting how it sources and gains its agricultural needs. And this has been a longer term shift. And we're seeing that real crunch point happen with US farmers. We saw it in the first trade war, the first US-China trade war, in the first administration. So many of the sort of hardest hit within the United States were the farmers, were the soybean farmers and elsewhere and others. And part of what we're seeing, I think, is China's capacity to shift over a longer term where it sources its agricultural needs. And that's part of, I think, why with the trade deal with the UK, for example, having agriculture within the conversation in the UK-US trade deal was so important, precisely because of what you're saying, Kriti.
If you're sitting in Brussels, what's your takeaway from what has just happened? What do you learn from this? How does it change the way you think about the way that you are going to be dealing with the United States?
I think what this is indicating, if you're in Brussels or even elsewhere, is that there is a real thread within the Trump administration that is seeking to de-escalate the chaos that has been marked the first few months of the Trump administration. There is a thread that's trying to create a set of norms and a set of ideas underpinning the actions that have been taken. I think it's very important, though, if I'm in Brussels or elsewhere, to keep in mind that this is very retroactive, right? That the chaos has already been unleashed. changed. And what Bessent is doing is cleaning up the mess. And it's a really important cleanup, and it's an indication that there is a willingness on the part of both the United States and China to negotiate. But it also, we need to keep in mind that it's coming from a place of having had the shop completely sort of uprooted. And that is a much more important, I think, longer-term thing to keep in mind, that there are members of the Trump administration, I mentioned Peter Navarro, but there are others who do take a very different approach to the way in which trade and the United States' place in the world should operate. And that isn't going away yet. It might, but it hasn't yet.
Not yet.
Not
Elizabeth,
yet.
Elizabeth, thank you very much indeed for joining us this morning and providing us with analysis. Perfect timing as we have watched that press conference and the news from it unfold this morning. Elizabeth Ingleton, Assistant Professor at the London School of Economics and author of Made in China, When US-China Interests Converge to Transform Global Trade.